Yo, 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 what's going on, guys? Can everyone hear me? Hello? Type in live. Alright, you can hear me. Cool, cool. Thank you, Inferno, for being the only one to answer. Alright. Let me just get everything set. This is my first time looking at charts since they opened at 6 p.m., so. Alright. Alright, so today's class, we are going to be going over higher time frame analysis, and then when I'm done, I'll probably just be going over a couple small things based on Friday that I saw happen where someone tried shorting on, I think it was Friday or whatever, and I'll kind of explain why you wouldn't short. Okay, and it was like a textbook kind of short, but I'll kind of go over that. So that's gonna be what I'm gonna be going over after when I'm done. All right. So higher time frame analysis. I know a lot of people kind of don't do it at all, or they struggle it. And the first thing I want to say for you new guys learning ICT, I would say higher time frame analysis is not totally required if you're new, and here's why. Okay, when I first started learning ICT, okay, if I went to like ESM, if I went to like the daily chart, okay, and I'm just looking for a bias, right? The daily candle, it's gonna be very, very difficult for me to guess on the daily candle where we're going. So the whole idea of a daily bias is you want to guess where the next candle is expanding to. Okay, but this is really a pretty indecision candle, so oh, I gotta share my screen. Sorry. Um, Here's my screen. By the way, I want to see if this plays out live. This is my guess for it now. I'm guessing we're gonna use this as an inverse for every like I'm go down. At least that's what I want. Um, so by the end of class, we'll see if that plays out. Obviously, the first target would be here. And then the next target would be probably. Oh, here's another really good lesson. So if I'm bearish off this, obviously this is the internal target, right? Okay. See how in this really there's no fair value gap. There's no I mean there is this order block, so this could be a take profit, right? Okay, but this would be the next low, which this low is kind of far, so what if you don't get here? If you ever don't know where to take profit, just draw a fib from the low to high and target the 50%. So target equilibrium. So this would be a good take profit. Because if you're wrong, we're going to bounce from here. That's another good thing. Okay, so for everyone to join, I'm basically explaining. If you ever don't know where to target price, draw a fib, target equilibrium. You don't even have to target this low. This is just another off-topic little thing I don't really talk about too much, but this is kind of my guess right now. My first target would be this order block, probably just because it's above equilibrium a little bit. And when this low hits, I'll put my stop to break even. So we'll see if that plays out. Anyways, if I go back to the daily, right? So bias on the daily, right? You really want to guess, okay, where's the next candle going to expand? Okay, but that can be difficult sometimes, okay, because we have an indecision candle here, and it looks like we're in a buy model, which I think we're in a buy model, so I think we're going to hit up here and then right here, right? But we also have unbalanced fair value against below. So as a new ICT trader, how is that supposed to help you? And first of all, if you're a new ICT trader, chances are you're not going to be swinging 50 million contract positions, right? You're just not. Okay, you're probably going to start for 5-10 handle moves. So in this situation, when you're new, I wouldn't really recommend, okay, get a daily bias, because that can be hard. It was very hard for me at first. So what I'd really recommend is off the daily, what you want to do is just mark the previous day high and previous day low. I think that's the most simple. So like here's the previous day high, here's the previous day low, and honestly, what you can do is wait till like either one is hit and then look to go the opposite way. So in this example right here, right? Here's the previous day high, or here's the high and low of this candle or of this range, and you can literally come in with no bias if you're new and just wait and just say, okay, if this high is gonna hit, this is what I'm gonna look for the 2022 model, right? And if you get it, great. If you don't, it's fine. So this is where you look for the 2022 model, and it doesn't matter whether we hit this one or this one. You're not trying to guess which one we're gonna hit first, but this is what to do is if you really you're bad or you don't or you're new, you don't have to do higher time frame analysis. You could just wait and wait till one of the daily highs or lows is taken out and then look for a setup. Okay, that's what you should do if you're really struggling. If you really want to get good at ICT, I recommend learning daily bias, getting good at it, because that will overall help you the best. But even if you wait for like if you mark out a range and you wait for one of them to be taken out, that's still an effective strategy in my opinion, because it's you're not going to be guessing which high and low is going to be going to. I'm pretty good at guessing which low and high we're going to get to first, based off of, okay, I see this here, I think we're going to go to this low first, whatever it may be. But I don't, when I was new, I had a hard time doing that. So if you're new, I'll just, again, for now, mark the highs and lows of the previous day, wait till one gets taken out, and then look for like a setup to go the other way. So that would be the basic thing I would start with. Say, for you guys really wanting to get good at higher time frame analysis, here's what I do. So I basically start in the weekly, and the weekly I look for broken PD race to the left, and I look for fair value gap supporting us in the way price is going in live time, right? So imagine if this is a 1 minute chart, okay? The first thing I see is we blew through this order block. Okay, what does that tell me? That tells me price should hit the next weekly high, so right here, and that's kind of my bias right now. Okay, obviously this would be the first target, and then this would be the second target. And the reason why I say that is because we could literally go over any of these price points because they're all so major, and we could literally just go like this and then go back up. And if this happens and you're in options or even futures, you're losing 50 points and then we're going back up 50 points again. So this is why I was at mark at the first target, not just here. But obviously my weekly bias, okay, I can pretty confidently say it's bullish, because the first thing I do is I look for broken PD arrays, which here's a broken PD array. Okay, we went above it. Okay, remember how I said it's really important to like mark this and take profits there instead of waiting till it's high? Just as how down here, see how we got this low and then this low. We never even hit this low, but we came so close, but we did hit this low. So this is still a take profit level. Besides, like when we were down here, a lot of people thought we were going to come to this low, as did I, but we never did. But it's still important to understand that we did actually hit this low, which was pretty major low. So yeah, I start off in the weekly time frame, and I look for broken PD arrays, and I look for PD arrays before live time. So really the one thing noticeable to me right now is we have a high momentum candle going through an old bearish order block, which tells me the draw should be the next high. Okay, looking for broken PD arrays is probably one of the most important things. And if you look at ES1, you can also see a leftover volume imbalance up here. So likely this is probably the draw, okay? But for now, this is the short-term draw. And another thing I do want to say is we did leave an unbalanced fair value gap here. And I always say it's a good idea it's a bad idea of longing this high, because there's always, let's see. Okay, so NQ just hit the first take profit, by the way. There's always a chance of this happening, which for my risk reward traders, this is the much better scenario, because that's going to allow the risk reward traders who want to get in a good long for us to get in a good long, right? But either of these could happen, and this is why it's so hard longing this high. You have to be very, very picky with setups, because I want scenario 2 to happen. I want this to happen this week. I want a right week back down to 4,080 or whatever it is, and I want us to bounce out this fair value gap, but that might not be the case, okay? No matter what, I'm still bullish. It's just I always look for two things in the higher time frame. Broken PD arrays, which this really tells me, okay, we broke through this with momentum. I think the draw's up here. And I look for unbalanced PD arrays. So here's the next unbalanced PD array. There's also one down here. But the reason why I wouldn't really expect a retracement all the way down there is because that would be back below this order block we broke through. So I would not want to see down there until like further down the road. So again, using the idea of, okay, look for a broken PD array, I can see momentum going through it. That should mean the draw is the next high. And then I always look for stuff over the volume imbalances, right? So, or I always look for stuff over the next highs. And above this next high, I see, what do I see? I see a volume imbalance. So not only do I think the draw is the next high, I think this is just a take partial, and I think we could probably go higher above the next high. A lot of people never know how high can we go past the next high. So here, I think we could go as high as this volume imbalance. That would make the most sense to me because there's still an unbalanced PD array up here, okay? Nothing else up here is unbalanced. This was rebalanced, you can see. This is really the only thing right here. So that's how I determine how high we can possibly go after. Okay, right now, obviously, I want to see this be cut through. But this is probably the really good take profit spot. And then this would be my final target right here, just so you know. So yeah, that's the two things to look for: unbalanced fair value gap and us breaking through old PD arrays, because that's going to tell me the draw, and that unbalanced fair value gaps is also going to tell me, like, okay, where would be good entry be. So that's what I look for in the higher time frame. I start with the weekly. If you're a scalper, I personally don't think the weekly matters, but I think it's nice to know because just for practice purposes, it's nice to see if your analysis on the weekly is correct. Okay, next I go down to the daily. And because the weekly shows me the same thing, it shows me the volume balance, the daily kind of shows me the same thing here. So we have the daily volume balance up here above this high. See how it's right above this high? That makes this for a possible good turtle soup entry, which means the second we break the high, you could probably try to short it. Okay, so right here, daily's basically telling me the same thing. I see we're in a buy curve, right? Buy model, which if you don't track the MMXM models channel, go study that. But okay, you can see this is a clear buy curve. You're starting to get that curve shape, and the draw to me would be this high. Okay, whether or not we get a retracement back down here or not, I don't know. I will react this week to that. Can you explain what a PD array is? Yeah, all a PD array is a fair value gap is a PD array. That I used to be confused about that too. A PD array is like a order block, a fair value gap. Any of the entries that ICT teaches, so like a order block, right? Fair value gap, volume imbalance, propulsion block, vacuum block, rejection block. I could probably name 5 more. Breaker block, mitigation block, inverse breaker, inverse everything, inverse volume balance. Okay, so that's what a PD array is. So really right here, the daily is telling me the same thing on the weekly, which is good. But the daily kind of tells me, okay, these are all unbalanced down here, and we have a leftover SIBI. So that's really more of, okay, it would be nice if we got this, because for us risk reward traders, this would just make the most sense. If we want to start a swing position, this would be a good spot to do it. Okay, now I guess you could chase, but it's not a good idea chasing here because we're just so high. Just if this was a 1 minute time frame setup and there was like, imagine this is the 1 minute setup, right? And we thought we were gonna hit this high. Would you really think it's worth chasing like 2 or 3 point move here? Just like if you were a swing trader, do you think it's really worth chasing in premium, right? If I draw the leg from right here, this high, to this low down here, we're way up in the premium. And even though I think we're going to hit buy side, it's just not a good idea tracing unless we retrace back to this. And in the daily, you can see these are all unbalanced, okay? This is unbalanced, and this is unbalanced. So eventually these are going to be hit, whether we hit this high first and then go down. But this is kind of the reason for, okay, on the daily time frame I look for 1 broken PD raise and 2 unbalanced fair value gaps. So another thing I do want to point out is, see how like on the daily this looks like we're just, okay, we just broke this high, right? And it looks like we're going for this next high. Okay, it doesn't really look like we've any broken PD raise here, but that's really what the weekly is for, because the daily and weekly will tell you different things. Weekly, I see, okay, here's a broken PD array. Even though we don't see this on the daily, I see we broke it on the weekly, which tells me that the daily draw is still up, you know? So that, sometimes you won't see broken PD arrays on the daily chart. Okay, that's why I have to look at the daily and the weekly just in case. Why are those 2 FUGs unbalanced? They balanced the FUG to the left of it. Why are these unbalanced? These are unbalanced because there's no, we never actually wick back down into these. Over here, can you give me a time frame? So someone's asked me, why are these fair value gaps unbalanced? When judging if we are in premium or discount, which time frame takes precedence? I feel like I could see us. Yeah, I get what you're saying. March 7th. Yeah, let me check. Are you talking about this one right here, March 7th? Okay, this is the inverse fair value gap. This was already balanced. Okay, this does not need to be balanced. A lot of people think this inverse fair value gap has to be balanced, but this is already balanced. Okay. The reason why I'm saying I want a retracement to it is because it lines up with these unbalanced fair value gaps, so it would make the most sense to me. But this is already balanced. I don't care about this, but this is another price point where we should see support off of. Okay. Do you get what I'm saying? And then Mitch also asked me, when judging or what time frame should you use to judge if we're in discount or premium? Okay, that's a loaded question. Obviously in the weekly, okay, you could draw many dealing ranges here. You could draw a dealing range from this high to this low, and realize, okay, yes, we are in premium in the higher time frame. So yes, I get we're in premium in the weekly, but that doesn't matter, because if I think the draws up here on the weekly, there's still going to be lower time frames where, okay, if we get a retracement, the discount in the lower time frame, then I'm longing. So like right here, this was an obvious low to high, right? Even though I know we're in discount on, even though I know we're premium on the weekly time frame, okay, even though I know that, I still know where the draw on liquidity is. And that's the most important part, knowing the draw on liquidity. It doesn't matter whether you're in premium or discount. If you're in premium and there's triple million equal highs above, we will blow right by premium and we will hit those equal highs. So like on the higher time frame, I know we're in premium on the weekly chart, but if I think I know where the draw on liquidity is, does it really matter if I don't long here or not? No, not really. So that's how I kind of determine it. And then even like if I go to the 5 minute, right, there's going to be your hourly swings, and then there's just going to be the mini setups with like this to here. Okay, and you don't, a lot of people get overwhelmed. I know a guy who used to DM me, and he had the same problem. He used to be confused on, oh, where do I draw the dealing range on every time frame? And he tried drawing it on every time frame, which loaded up his chart with 0.5s. But I think it's just imperative to understand whether you're in a higher time frame, like discount or premium, and just knowing, like, because technically we are on in the premium on the hourly and weekly, it is just more risky longing up here. That's why, like, ICT says he doesn't long unless we're in discount on like the hour or 5 minute, right? He's not going to take even if we bounce here, he's not going to take a long here, because the setup already presented itself down here while the hour was in discount and while the 5 minute leg was in discount as well. So that's just important to note. Okay, so NQ is doing exactly what I want right now, which is perfect example for this class, because you guys can actually see me call price live, which I'm not trading this because it's Asia, but it's still a nice nice thing to watch. And ES should hit this low. Okay, so you can see that's kind of how I do it. And again, that's a whole nother conversation, a whole nother class on discounted premium. I think it can get a little complicated. But that's what I would say about that. So if I go back to the daily, right, and again, if I go back to talking, okay, so I see we have unbalanced fair value gap here, unbalanced fair value gap here. To me, if smart money really wanted to load up again, I really think they'd bring it back down here, then bounce up to hit this draw on liquidity. And the reason why I think and 100% know that this is draw on liquidity is because of two things. One, we have high momentum above this old fair value gap and this one as well. Okay, so we broke both these fair value gaps to the upside, which again, and we broke the weekly order block, which all three of those tell me, okay, the draw should be up. But we know that this is still pretty high, and even though the draw is up, wouldn't you want smart money if they really wanted to get in? Wouldn't they bring it back down here? I mean, I think they would. I mean, sometimes they don't. It just depends, but usually that's what you want to see happen. So that's kind of my daily and weekly, and I think it's nice to know, even though I scalp, I'm mainly a scalper, right? I still like to do analysis on the daily. I think it's just good practice, and you can kind of guess. So if you don't already, okay, you could literally practice buying SPY shares if you want to practice your higher time frame analysis to see if you're right. Instead of risking a whole contract, practice buying SPY shares, like a single SPY share and swinging them. I think that's not a bad idea. And in the future, okay, ICT right now, he's teaching us how to get 5-handle moves, 10-handle moves, okay? Don't you think 5-10 years down the road, wouldn't it be nice to call these 100-point moves swings on SPY and ES and all them? I mean, I think it would, and that's really what I think he's trying to gear us towards. I think in the future that could definitely be possible. So yeah, learning these 5-handle and 10-handle moves now is cool. And now that we are learning these 5-handle and smaller time frame moves, it's just going to be the same thing on the daily and weekly, right? So it's kind of good to just practice the higher time frame analysis, especially for the future, because I think more professional traders, they're not scalpers, they don't day trade, they swing large positions, okay? So I think in the future that might be a possibility if you want to try to get good at that. So yeah, so after the daily and weekly, I usually go down to the 4-hour, and the 4-hour to me shows me a lot of little fair value gaps. Like, yes, I know there's daily fair value gaps here, but 4-hour to me, I really look for the smaller fair value gaps that we've kind of broken and we form. So right here, the first thing noticeable to me is this fair value gap held us down for quite a while. And the second we break above that with this size of a candle, okay, even though I know in like a higher time frame, okay, the daily's definitely bearish. Even though I know in a higher time frame, I think it's important to mark out, okay, we have a bearish fair value gap here, and we held it. We never, you can see how algorithmic this is. We never actually got a body close above it, and then boom, finally we get a giant green candle going over it. And this really is going to tell me, okay, even though I want this to be unbalanced, it's still important to know that this is the fair value gap lined up with this momentum candle, because it's just like the 1 minute chart. Sometimes in the 1 minute, what happens is we get a fair value gap, something like this, and let's say discounts on here. And sometimes we never just retrace into it because this is either a breaker up here or it's just another inverse fair value gap, right? And it's the same thing in the 4-hour. Even though like that my bias is I want it to be bearish and I want to rebalance these before more upside again. Okay, it's the 4-hour time frame and the 1-hour time frame tells you, okay, here's a mini fair value gap, so here's where we could see a mini retracement before possible downside. So like the fair value gap, I think overall the 4 hours best to determine, okay, would this scalp or would this day trade make sense? Because ideally on if I was short, which I shorted on my live on Friday, right? If I was short and I saw this and I thought we wanted to balance these, then my target would be here, which it was. And you still want to realize, okay, all this is a 4-hour fair value gap. So even if I'm wrong, we will bounce up this fair value gap. And you have to be very, very understanding of that. If you're on the daily and you thought, okay, I'm holding a swing until the low of this, till this low, right? If you're doing that, you're never going to see the fair value gap unless you're in a 4 hour, 1 hour. So the 4 hour and 1 hour just show you, okay, here's a major point of interest here, here's where we can see a possible reversal. Here's a good scale spot. So that's what I use the 4 hour and 1 hour for, which I'll go to the 1 hour in a second. Okay. If you imagine this candle, I'm imagining this is probably a few different candles in the 1 hour. Okay, and I'll show you what I mean by that in a second. So this is why I like the 4 hour, because I think it's much cleaner. And again, discounted premium on this leg right here, you got to understand that this is the discounted premium. And as soon as we get here, it's just very, very dumb. Even if you think we're going down here, it's dumb to short. So like Friday, I literally said in my index commentary, I'm pretty sure I said something like, I might have said in chat, I can't exactly remember, but I said, okay, I'm short. I think we're going to go 96, which is 4,096 down here. But I said, I would prefer long here. Okay, and the reason why I said that is because we're just so low and we're a discount. And I was expecting like a smaller retracement, something like this. But it's important to kind of know where the fair value gaps are in case your bias is wrong. Or if your bias is wrong, you'll still get these small retracements out of these spots where, okay, if I was long bias and if this fair value gap was in discount, this would be a good long spot, right? And if you have a hard time switching biases, you're going to get wrecked. Like, if you have a hard time understanding the other side of the trade, you're going to get wrecked because there's always going to be two people on different sides of the trades. There's always going to be two different biases. I guarantee you people who come in my voice chat, some people are bearish for the day, some people are bullish, but it doesn't matter because the bearish people, they're mostly probably going to get up here after we hit buy side. The bullish people aren't going to get down until a good long entry. So it doesn't really matter if you're bullish or bearish. There's still good entries for both sides. Okay, so again, 4 hour, I like to just mark out the fair value gaps we've broken, the obvious fair value gaps. And here there's no obvious fair value gaps besides this. Okay, so that's what I use for the 4 hour. 1 hour, same thing. 1 hour, you can see what? There's a fair value gap here. Is it a discount? Nope. And there's a fair value gap down here. This was a discount. But this was 1, 2, 3, 4, 5 green candles in a row. That's why I go back to the 4 hour and I just know, okay, this is actually all one fair value gap. Even though it looks like a bunch of them on the 1 hour, it is still 1 hour. It is still one in the 4 hour, right? So that's what I use a 1 hour for. I kind of use 1 hour to see if there's any more narrow fair value gap. So in this situation, I'd argue, okay, there's two fair value gaps in the hourly. This one, this one. This one is in premium. This one is discount. This one also matches up with this SIBI. And was this on the 4 hour? No, the SIBI on the 1 hour is not on the 4 hour. Okay, and this is where some of this can go over your head, and that's okay, because if you're not doing analysis in every time frame, you're probably gonna have a tough time, because some people just sit in the 4 hour, they don't go to the 1 hour, so they don't realize, okay, this was a SIBI. Okay, anything other than the 1 and 4 hour, I think this is enough. I don't think you need the 2 hour. I don't think you need the 3 hour. Okay, a SIBI and a fair value. A SIBI, all a SIBI is a 4 hour bearish fair value gap. A SIBI is just a fancy saying for it. Same thing though. So yeah, some 4 hour traders might not realize, okay, this is a 1 hour SIBI. Okay, inversion fair value gap, and this is why it's important to kind of, okay, you don't have to mark all these fair value gaps. Like, you don't have to mark every single one. It's just important to know where they potentially are. Okay, if I have a pretty good memory, and I think it's important. I think it's very helpful because I try to memorize where a lot of them are. And when day trading, I kind of keep in mind, like, okay, I think the bias is down to 9.6, but I keep in mind, I'm like, okay, but I know we are going to 1 hour fair value gap. It's probably getting pretty stupid to short down here in case my bias is wrong. And that's kind of exactly what happened on Friday, where I bet you a lot of people shorted down here, and they probably get wrecked because even though I thought Southside was 96, would you really want to short when we're in a possible long entry if your bias is wrong? Probably not. Okay, I don't care if it works. Again, I always tell people, I don't care if we keep going down. Okay, if I don't short here and we keep going down, I don't care. I should have been short up here. I think down here is chasing. And Friday was a prime example of, okay, if you tried doing that, you would have gotten wrecked. And sometimes when I say, okay, I don't care what happens here, and we do go that way, I don't get mad. And people might say, oh, well, we kept going down, why didn't short? And even though the short works, it's just I know there's going to be other situations where it's not going to work. So this is why I kind of stay out from longing or shorting when we go this low. So yeah, this is what I 1 hour. I just look for more precise fair value gaps, such as this one and this one. Even though I know this is a full 4 hour in itself. Same thing with right here. I know, yes, this is a fair value gap. This is the fair value gap. Like I know they're two fair value gaps, but if you kind of imagine what would this be in a higher time frame, it would probably be one single fair value gap because imagine like a demand zone. There's going to be a lot of orders sitting here. Okay. Even though this is not a demand zone, which don't try to argue with me, it's not a demand zone. Okay. This right here, you have to imagine, okay, this probably combines in the one fair value gap. Okay, there's like, so let's take this this order block for example. Okay. There's 1, 2, 3, 4 down candles before this up move. On the 1 hour, you see this is 4 consecutive candles in a row. But would this be a 4 hour fair value gap in the higher time frame? Let's check. No, it would not. Okay, there is a 4 hour fair value. Oh wait, actually, this is a bad example. Yes, it would be a 4. So, yes, this is a 4 hour 4 hour order block. Unfortunately, I was hoping it wasn't. Anyways, I think it's like this is a 1 hour order block. Okay, 1, 2, 3, 4 down candles before that move. Okay, this doesn't have to be a order block in the 4 hour. Just because we use a 1 hour and 4 hour doesn't mean anything because this candle starts at 1 a.m. or 1 o'clock p.m. and it goes till 4 o'clock p.m. and it kind of ends here. And this is actually the open of the 4 hour candle. If you know your candle openings, it goes 10 p.m. to 1 p.m. So this is actually the open. So this is actually a bad example of what I'm trying to say here. But if this was, let's say this was, let's say 11 a.m., 12. So this was 11 a.m. This was 12 p.m. This was 1 p.m. This was 2 p.m. This will not be an order block in the 4 hour because the 4 hour opens like when we get down here. So technically this would not be an order block if the times are changed. So what I'm trying to say is the 1 hour, this is an order block. You can clearly see it. 1, 2, 3, 4 candles for a down move, and then we get an up move. Okay, so you can clearly see how this is a order block, and we have not retraced to it at all, but you would probably see reaction off of it. And what you want to realize is, even though this might not be an order block in the 4 hour, okay, it's still going to be an order block on like the 3.5 hour, 37-minute time frame, something you can't see. So this is why it's important to know, okay, this might not be an order block in the 4 hour, but it's still going to be an order block on like the 3 hour, 20-minute chart or whatever, which we do not see because time is all fractal. So it's just, that's another really important thing, which some people be like, oh, well, this is an order block on the 1 hour, but it doesn't actually translate on the 4 hour, so they kind of disregard it. But this is still an order block in another time frame you probably can't even see. This is why it's kind of important to mark those. And yeah, I agree, Ryan. Okay, I've chased price in the past, and I've been successful at chasing price, but there's a time and place for when you want to chase, and for everyone who joins my live stream all day, okay, you know I will chase at certain times, and I kind of hint towards it. And there's also times when I'll not chase price, so I'll be like, okay, I really want to chase here, but I don't think it's smart, and I'm just not going to chase. Okay, there's time and place, but over longevity-wise, it's not a good idea. And even if you didn't chase and the play still goes where you think it's going, okay, you can't care because next time that's not going to happen. Okay, it's not consistent enough for sure. Yeah, I call it a technical chase. It's kind of a term I coined. I haven't heard anyone on Twitter or anyone say it. I kind of made it up myself. Yeah, I call it smart chasing, and I'll do like a video or a class on how I smart chase a little bit. Couple of smart chases have to do with like trend line breaks, line up with, okay, I see liquidity down here. There's also a trend line break. Okay, different scenarios. I'll go over that some other class. Was there a setup to go short of those top two candles? Are you talking about this? Devander. Yes, there was a setup to go short here. Okay, see these equal highs over here? So we have these equal highs, and then what do you see above these equal highs? You see a 4-hour fair value gap right above it. So this was not a lucky guess. This was calculated. Okay, fair value gap above equal highs. Those are money. Yes, we shorted that in live, Sully. And I actually alerted this short in live, but I didn't alert it until it kind of, if we look at kind of ES and NQ here, okay? If we go back to like the 1 minute on Friday, this is another important lesson. So we were about right here, and everyone in my live is going to remember when I said this, but basically what I said is, if we go back, we were like so we were inside this fair value gap as a whole. I already knew that. And we were like right here, and I'm like, okay, this would be a lower sell when we were getting up to it. I'm like, okay, this would be a lower sell, but it would not be high probability because to me this looks like a V-shaped recovery. It looks like the momentum should hit this high, right? And why was I wrong? Well, I said this, and we were still in this fair value gap, and then I quickly took a look at NQ. NQ, same setup, V-shaped recovery. The draw should be this high, and what happened? We hit the high in NQ. And because we hit the high in NQ, and I was like, okay, we hit the high in NQ, and ES kind of had this red candle right after, and then we had this hanging man candle, this bearish candle, if you don't know your candlesticks, right? And I started seeing it fall a little bit, and I'm like, okay, now that NQ hit the high, and this is still struggling, now this would be a much better short. And I kind of mentioned it. I was like, okay, now the short should work. I think I said this short should work now or something like that. And we just totally dumped after. And then right here, I'm like, okay, I'm going to get some puts for next week. And those went 25%. And they were like 4 DTE. Okay, 0 DTEs probably went like 300% or 200% here. Okay, but that's kind of what I alerted there. Can you write your analysis process on a tab so we can do step by step? Elias, I will. I'll probably do that in like I'll do that in a private thing. I don't want to overwhelm people right now. Basically, my analysis, if I were to say it in words, I start from I just do top-down analysis. At the beginning of every week, I look at the weekly, then daily, then every single morning, I make sure I understand, okay, here's the 4-hour fair value gaps, right? I kind of memorize where all the 4-hour fair value gaps are. I look to see, okay, are we getting momentum in the 4-hour, which right here we did. So I know that this is like a possible place that even if I'm bearish down here, I still know we can possibly bounce off here. And then from there, I just go to the 1 hour and I look for these mini fair value gaps to see like, okay, if we're going to react from that. I don't mark every single 1 hour fair value gap. I kind of just keep them noted. I'll mark ones. So I love these fair value gaps. See how this is an order block with a fair value gap above it? These are pretty important to mark. Okay, because these are kind of like double support. We don't have to hit the order block, but basically these are very strong because we had an order block supported with a fair value gap. These are the ones I like marking as well, and I know it's a discount. And then another thing, once I really know where the 1 hour, like, again, no obvious fair value gaps in here. There's this fair value gap I see here. Okay, what happens? We just dump through it, okay? Again, this goes back to what I said about chasing. We are very overextended at this point, so why do you want to chase the fair value gap this high, even if it works? And then once we dump through it, I see, okay, now this lines up with a new fair value gap, and I see a new fair value gap right here. Okay, these are the only two fair value gaps in the leg. These are the only fair value gaps where, okay, here's momentum. Here's where price is going to interest me. Price does not interest me in all this chop. Price interests me when, okay, I see momentum, I see fair value gaps. Now what's going to happen when we retrace to them? And we can see, like, there's probably plenty of short opportunities here. And then there's a short opportunity here. Remember I shorted this, okay? But if price is doing stuff like this with creating not creating fair value gaps, price is not going to interest me at all. Okay, it only interests me on the higher time frame when I see, okay, here's momentum, here's a few hourly fair value gaps. And Raul, I will answer your question in one moment. So yeah, and again, 1 hour and 4 hour. Imagine this on a 4 hour. This would probably be just a single fair value gap, but on a 1 hour, it's important to note that okay, this was rebalanced, and we still have an unbalanced 1 hour up here. That's just another important thing to remember. Okay, and then once I'm done with 1 hour, okay, I'm not so. Yes, these are multiple candles in the 1 hour. Do I know there's probably going to be a 15-minute fair value gap in here? Probably. But if I know it's already a 1 hour fair value gap, I already know, okay, there's probably going to be a potential bounce spot somewhere in here. Okay, I'm not just going to keep going to lower time frames being like, oh, I'm going to get even more precise and draw out this fair value gap, right? I know somewhere in here we should get a bounce. And I'm not going to just randomly long inside any of these zones because this could hit or this could hit. I don't know. Okay, so again, I'm not going to keep going to smaller time frames and being like, oh, well, I'm just going to try to pick a more precise spot, right? Ideally, what I'm doing is I'm waiting for a reaction off of one of them, and then that's when I look for the long setup. Okay, I'm not just going to blindly long when we come back down to these because by the time we come back down to these, we're on a whole different side of the curve. We're days away. These might not even matter anymore. So that's kind of why I just keep them noted on like the 1 hour instead of, okay, I'm not just going to go to the 15-minute, 5-minute and keep marking all these tiny fair value gaps because we could bounce out of any of them. I know the full thing's a giant hour fair value gap. I know it's a 4 hour fair value gap. So anywhere in the zone is fine with me. I don't care where. So that's kind of another thing I do. Okay, anything in the 15-minute or lower, I am trading real price action. What does that mean? I'm not doing higher time frame analysis in the 15-minute lower. I am strictly trading price action I see formed live time. Okay, I'm looking for live order blocks, live fair value gaps. Right, I see this is the fair value gap right here. I see we have a nice low right here. So what I expect? I'd expect is to go underneath this low, hit this fair value gap. I also see low resistance liquidity forming. My guess is we're probably going to break above this at some point. I'm not sure where, and maybe go like this and then down. I'll have to see. But this is too clean. We're probably going to break this at some point. But yeah, the 15-minute, I don't look at old price action. I'm not going over 50 million years and drawing these old fair value gaps. Unless, so like this one, yes, I would draw one, like if I go to replay mode. Yes, I'm drawing this one. The only reason I'm drawing this one is because this could be used in inverse. Okay. By the way, this is a really good indicator I want to go over after someone showed me this, the macros. I'm going to do a class of macros next week. I think they're really good. So like, again, buy side of the curve, sell side of the curve. I'm still marking this. I'm not going to mark ones from way over here after you've already used them. Okay. But like this one, why is this not loading? This one, because it's still unbalanced, I'm going to mark it because, yes, it's unbalanced. You could see it used as an inversion. So, anywhere we have our sell. So, here's what I'm going to explain. We have our real-time sell side of the curve right here. That's totally unbalanced. And we have a real-time buy side of the curve. We also have another old sell side of the, or old buy side of the curve, and then we have an old sell side of the curve. This is an old curve. This is a new curve that still has not played out yet. So if it's on the new side, if it's on like the live curve that hasn't really completed or hit buy side, then yes, I will draw the fair value gap in the 15-minute. But other than that, I'm not going back 2 months and drawing old 15-minute fair value gaps because I already know the 15-minute fair value gaps are kind of be in the midst of these 4 hour and 1 hour fair value gaps, which is where I'm already looking for us to bounce anyways. And I'm not going to overcomplicate it by drawing 50 million more zones, you know? So yeah, 15-minute, same with 5-minute. I'm looking at live price action on the 5-minute. I'm looking for live fair value gaps formed in live time. I'm not going back 5 months and drawing all 5-minute fair value gaps, right? But yeah, that's how I use this time frame. Only the hourly, 4 hour, daily, weekly, I draw old fair value gaps, really. Okay? But this is all live. I'm looking for live price action on anything 15-minute below. And yeah, that's kind of how I base my higher time frame analysis. I think it's just again, that's what I just said. Is I'm not trying to say, oh, right in your nose, but everything I just said is a gem. Okay. Again, you can do 15-minute for your higher time frame analysis. I just recommend hourly and above. 15-minute only look at the current fair value gap, so we're actually in on the 15-minute, because I think that's a small enough time frame where people are day trading the 15-minute. Okay, people are probably not day trading the hourly. People are likely using the hourly for a bias, not really entries. So yeah, that's what I would say about that. And a lot of people don't really understand, okay, what time frame should you use for this? A lot of people just say, oh, time is fractal, use any time frame, which I hate that answer. Okay, so Raul asked when to enter at breaker versus fair value gap. There's a breaker entry that we disrespected. Okay, I see what you're saying. So you're... Before I go over your question, I do want to go over one thing. My equal highs and equal lows rule. I always say don't long or short with equal highs below, which is a good rule most of the time. Except, okay, if we look at last Friday, okay, I think it was the 5-minute. We had these equal lows down here, okay? Equal lows. And yes, although I think these will be a target at some point, okay? If I'm short here, I will hold runners to these equal lows, and I will gladly get stopped out. This would be a situation where you're going to be holding runners to these equal lows. You know those equal lows. I will gladly get stopped out. But I made a post on Twitter, and I said, okay, if we have equal lows or equal highs, but it's also an SMT, then I'll disregard them. So on Friday, what do you see in the 1 minute? We see, okay, we have equal lows down here. And yes, it would be nice to sweep these before going up, but if I bring a side by side chart with NQ, okay, this was an SMT, and if this truly is going to be a reversal, then these equal lows should not matter, because these equal lows already swept price once. So these should not be swept again if it was an SMT. So this is the only exception I have to this rule. If I see an SMT here, what you can see, this is an SMT for you guys who don't know what an SMT is. Okay, it's when NQ makes like a higher low and ES makes a lower low. Same thing with NQ makes like a lower high and ES makes a higher high. That's just called the smart money divergence. Okay. Anyways, these equal lows, some people probably didn't log because these equal lows, but when this is SMT, these should not matter. And another time when I don't really put a lot of weight on equal lows is if we're getting like barcode candles, which means the volume is probably like right here. You can just tell there's not a lot of volume here. But that's kind of another thing. I don't want to get too much off topic. Anyways, this was an SMT, so I'm disregarding these. I still know there's these down here, right? Off the 5 minute, which are clean, okay, but I know this is an SMT, so now we can have no bullish SMT in real time, okay. So yes, it would be nice to hit these equal lows on here, but you can't disregard, yes, this is a bullish SMT. We swept price once, we have a bullish SMT here. So even if I think we're getting down here, we should see short-term upside here. So that's really when I disregard equal lows and when I've been starting to disregard them. That was the other thing I wanted to go over, and Burr, I'll get on a call with you after and go over that with you. But that's that. And then Raul asked me when to enter breaker versus fair value gap. There was. Okay, so Raul, something that I did notice is that is the 5 minute time frame. So you kind of, if everyone goes to live chat, look at the screenshot Raul sent, kind of, so everyone knows what I'm talking about. Okay. He said, so you was on the 5 minute, and what it looks like what you said is this. Okay, you label this a market structure shift, which this is really a market structure shift on the 15 minute. Okay. This is very deep, and it wasn't really something that I understand for a while. this would not be a market structure shift on the 5-minute. This is more of, okay, this is a target. Like if you longed right here, this is a target, not really a market structure shift. The market structure shift, you really can't tell it's a market structure shift unless you're in the 15-minute. Okay, the reason why I tell that is because it's 1, 2, 3, creating one single swing high, and then we blow past it. So really the 15-minute, this is a market structure shift, just not on the 5, not on the time frame you marked. That is a little, again, some people will not understand that and will be like, oh, well, it's a market structure shift in the 5 too, okay? Yes, it technically is, but it's more obvious that it's a market structure shift in the 15 versus on the 5. It's more of a target from this fair value gap. Anyways, you have the sell side liquidity, right? You saw, okay, we swept this low, okay? But here's another thing. We swept this low, okay? We swept this low. Why don't we reverse after hitting this low? Well, we never got a long setup after sorting this low. This is a low where, okay, in live time, you're not going to expect price to go like this until you see a long setup. So if I'm in replay mode, right, I'm not just going to label this and say, oh, we swept south side liquidity, so we should go up here. Well, what if we do this? And then reverse. So you don't know that this is the south side we sweep until we get the long setup. So this is more of a hindsight thing to where, okay, yes, this is south side liquidity, but there is also south side liquidity here. But why reverse after hitting this one? It's because after this one we get the long setup, right? So that's just another thing I want to clear up. And then you said, why do you disregard the breaker? Can you show me where the breaker is in that screenshot? Are you talking about this candle right here? Is Ali Yusuf? That's what I want, or else I'm not really gonna be longing. So, okay, yeah. So right here, obviously the best stop loss is gonna be under like the last swing low, which to me this is the last obvious swing low. So we actually never hit it, but I think the smart stop loss for breakers is under this. Okay. So I'm not sure if I would consider this a break or not. I probably would not, because technically this whole leg is a breaker. This. Okay. If we look at the 15-minute, okay. See this 15-minute candle? This is the breaker block. Okay, so this is another little, might be a little too advanced for some people to understand, but I get where you're coming from with, okay, just this candle's a breaker, but technically it'd be this whole leg up, because if you thought this was a breaker, right, then that means every swing high and swing low would be a breaker. This should just a normal swing. Like, that means, okay, this is a breaker, this swing low is a breaker, this swing high is a breaker, right? You could literally call everything a breaker if your logic is, okay, just this candle's a breaker. So on the 15-minute, it's really, this is just a single breaker, because, again, it's a green candle sandwiched between two red candles. So it's just a single green candle. We take sell side, and then we break above that candle. So this would be really the breaker, and you can obviously see this was much cleaner. And on the 5-minute, you're probably confused. Why did we go under the breaker? Well, we didn't really go under the breaker. It's a higher time frame breaker. Do you get what I'm saying? So that's just something important to note. Or else you could classify everything. You could classify this swing high, like you could classify every swing high and swing low as a breaker if this was the case. You like the pair of breakers with a mitigation box? Well, that's impossible, because they're basic. You can't pair them. They're the same thing. Just one doesn't hit. One doesn't purge liquidity, and one does. Okay, let's say Actually, it might actually be on NQ. Wow, do you guys see this? Remember how I drew this order block? Look at this. Look what this candle did. It tapped the order block to the cent and just totally dumped, and now it's back up here again. So if we go like the 15-minute from... So look right here. This would really be a mitigation block right here, because when this candle's formed, we don't go back down and hit the low. You can only have one or the other, a mitigation block or a breaker block. You can't pair them, if that makes sense. Unless it's like another mitigation block from way over here. If it's like a breaker here, then a mitigation block from here. I don't know. That's probably a lot more rare. So a mitigation block is the same thing as a breaker. So this is a breaker block because it's a green candle, right? Before down move that hits liquidity or purchase liquidity, and then when we break back above this green candle, that's when you want to see it use as support, just like an order block. But an order block here would be these two red down candles, and then a mitigation block would be something like this. Same thing, break above the green candle, except before he broke above this green candle, did we take the low? No, we did not. So this would be a mitigation block. Or in other terms, an unmitigated breaker. The red box. Yeah, so that's the thing. Retail, I've had a lot of arguments with people on this on Twitter. Retail does not understand that this is not old resistance turned to support. Okay, this is not old resistance turned to support. Why? Because this whole candle's a breaker. They don't understand that, and they think, oh, we broke above swing high. This should be used as support. And although that happens sometimes, let's say these candles were red right here. Okay. Let's say these candles are red, and let me just visualize this. If these were red candles right here, right? And we got the single green candle right here, then I would expect this to be support. But what retail doesn't understand is they expect this to be support after every single swing low and high, because they don't know the breaker blocks or whatever ICT teaches. Because yeah, they just expect every swing high and low to be a breaker, which is not true. If that was the case, the market would be in easy mode. If you could just buy it every single old swing high we break over, that'd be way too easy. So you have to understand the context. So if these were red candles right here, then I would buy here, and I would not expect the retracement back under. But because these are green candles, anywhere in here is fine. Yes, exactly, Inferno. I like that. You have very good understanding of that. Yeah, this is not a supply zone. Again, supply and demand zones are, I could go on another lesson about those, because I still think supply and demand's fine in commodities, just not in indexes. I would really consider this to me would be a supply zone. And the reason why is because, like, stair stepping up and then boom, elevator down, there's probably going to be a lot of leftover orders here. So this, if this was like a commodity, like this was like a Apple, I'd consider, okay, this is probably a likely supply zone. Versus like this is just a swing high and a swing. This is just a normal swing high. This is just market structure. This is not any important supply zone in my eyes. For a failed swing reversal, do you require SMT? A failed swing reversal usually is SMT. Like if I see ES technically, or if I see an NQ. By the way, look at this. See how much this order block is holding us down here? That's, if we break back above this order block, what does that tell me? That probably tells me we're going back up to this high. But as long as we stay below this, that's what I want to see. Yeah, a failed swing like this to me would be, okay, this is kind of a failed swing here. like the chances that this failed swing on Q is an SMT is pretty great. Okay, you just gotta check the other charts, and you can see this was an SMT. So yeah, I don't require an SMT. Usually it already is an SMT, if that makes sense. And if you guys didn't read my 3D analysis, how to go over 3D analysis, how I switch between YM, NQ, and ES all day, I go recommend reading that. If you're newer, don't read it yet. Bookmark it and read it sometime later. So yeah, that's all I got about for now. Does anyone before I kind of finish this up here, does anyone have any questions? I know some people have already been asking them. By the way, I did a poll on my Twitter. I said how much should I reprice my premium to. A lot of people said 50. A lot of people said 25. For you guys who, I think I'm deciding to do 35 because I think 25, anything below 25 or under is too cheap to where, okay, people are going to join. They're going to be able to waste that money in full port plays, and if it doesn't work, so be it. But I think 35 is good value where, okay, if I'm joining for 35, I'm not going to try to blow my account on one play, and I'll actually try to learn. Like, I think it'll be more value instead of, okay, I'm joining for 15, that's nothing, I'm just going to full port everything he says, you know. Because so that's what I'm going to do for you guys who are interested in that. And that will be open again on May 1st. Eric, if I made my premium $5, you know how many DMs I would get a day? Oh my god. I keep up with my DMs pretty good, but it's been getting difficult. By the way, this is a kind of a tricky scenario, so I think we're gonna break over this trend line. By the way, guys, whether we take out the slow or not, I think this would be very. If we left this trend line up here, this would be a very nice long.
Hey Ryan.
1 second, guys.
Ryan.
Wait 1 second.